Hi, Todd Pouliot, Gateway Financial. Really excited to be here again today to share another flow chart with you. And we've got a real exciting one here. Doesn't matter what's going on in the world, this flow chart can be very important, whether or not there's any turmoil such as pandemics or wars or whatever's going on. There always seems to be something in the news and people start asking the questions of, should I sell an investment? So determining the tax impact of selling an investment is sometimes complicated. There's several questions to ask to ensure that your tax liability on the sale of an investment is calculated correctly. So we have this flow chart here. Will I have to pay tax on the sale of my investment flow chart? And it addresses some of the most common issues that arise for us and understand the tax implications of selling an investment. So we want to consider these following four things: capital gains versus capital loss, long-term versus short-term status, tax brackets and applicable rates, and Medicare surtax calculation. So as we always do, we're going to come over here and share our screen. And obviously we'll update it as we keep going forward, but is the investment held in a tax-deferred retirement plan or annuity? Very important question to know what asset and the asset location. We always talk about asset location, but we never define that. Is it in a qualified retirement or tax-deferred retirement plan? 401k, 403b, IRA, think those things, Roth IRA. If it is, you will not be taxed upon the sale. You may be taxed if there was a distribution. So be cognizant of whether or not it's just an internal sale or if you're selling it for a distribution and what that tax situation is. If it is not, is the investment worth more than your cost basis or what you paid for it at the acquisition? Obviously, we're going to play with this chart, but if the easy answer is no, you have an unrealized loss, which could reduce your tax liability. Again, always consult with your CPA or tax preparer and make sure you have the data with you. And obviously, we do a good job working with our CPA that we have here in the office. Is the investment worth more? Let's say yes. You have an unrealized gain and only have to pay tax on the difference between the sale price and the cost basis. So if you bought something for $8 and it's now $10, the difference is $2, and that's the taxable amount that you would pay. And the same if it's $80,000 and $100,000. Be aware zeros do make a difference in the amount you pay, but understanding that it's only the 20% gain that you'll pay on the tax. Did you hold the investment for more than 1 year? Several times I do see people selling just shy of that 1 year, and it can be a drastic change in the amount of tax they have. So long-term versus short-term. So let's say no, the investment qualifies for short-term capital gains treatment. You will be subject to the tax based on your income tax bracket. And if you did hold it for more than 1 year, this qualifies for long-term capital gains treatment. And look at your tax table for your earned income plus any investment income. So up to $83,000 for married filing jointly. Now, I do want to put a little caveat in here for estates and trusts. That number is extremely low. Make sure you understand that trust and estates are taxed extremely differently and extremely high. One of the reasons why I do not like trust being named as beneficiaries of IRAs, or if you don't have a lot of assets, you are going to be climbing these tax brackets really quickly. And in fact, if I'm going to jump down to the highest tax bracket, it's only $13,700. I really want to consider whether or not that trust is important. There are certain reasons, special needs, and other situations where trusts are very effective, but we want to make sure that we understand taxation on estates and trusts. Again, married filing jointly up to $517,000, and the top tier bracket at $517,000 begins there, and that tax at 20% versus zero at $83,000 for tax on the gain. And then this big gap between 83 and 517, that tax is only at 15% versus your income tax rate. So we want to make sure that we understand capital gains tax long-term is significantly different than your income tax rate. Very, very important to understand those differences there. The other thing you want to consider if you follow this flow chart is understand the modified adjusted gross income, 200,000 for single or 250,000 married filing jointly. And again, there's that number 13,450 for estate trust. You are going to be paying higher taxes, what is called the net investment income tax. It's 3.8%. So make sure you understand these, and also whether or not you're subject to AMT or alternative minimum tax. Those are not as common as they used to be with a lot of the changes from the 2017 Tax Cuts and Jobs Act. Do understand that that law is going to sunset in 2025. It is expected to sunset. And we may have earlier changes since we've had a change in administration on tax laws. So at the latest, I would look at 2025, and maybe it happens late in 2022 or 2023. Make sure you understand where taxes are going. Also, make sure that you understand the sale of your investment may also increase other incomes such as Social Security taxation. And I will tell you, we talk about this a lot, IRMA surcharges. A lot of clients are very concerned. I want to stay in that lowest IRMA tax bracket so I don't have my monthly Medicare premiums increase based on those. Very good to know all the tax brackets, where they all come in, and understanding that sometimes, not all the times, but sometimes tax preparers are very good historians. They are not very good tax planners. So make sure that you are working on a tax plan along with your tax preparation. That's one of the things that we like to do here. Once a client has their 1040 done, completed, turned in, we take that PDF, we upload it into the software, and we start doing tax planning based on a lot of these things. Will I have to pay tax on the sale of my investment, and what bracket is it in, and can I adjust it, and what does that mean to my Medicare Part B premium? These are all very important things to discuss. Make sure your financial advisor is looking and reviewing at your 1040. I would say that the number of advisors who do that is extremely low, but tax planning will save you so much money now. And maybe it's important to pay the money now versus paying it later. Understanding tax brackets where they are today and where they might be in the future. Sometimes charitable giving might be an additional way to take a highly accumulated asset. It has a lot of capital gain, and you can just make that as a donation to your favorite charity or donor advised fund. Love to talk to you more about that. Hope you enjoyed this video. Hit that thumbs up. We much appreciate it. Subscribe to our channel, and we'll keep bringing you great content. And we appreciate you being here and hope you have a great day. Thanks and goodbye.